Thank you for joining iMeet. When you hear the tone, you will be the 22nd person to join the meeting. Now being recorded.
Hey everybody, good afternoon. This is David Blake with the Tuesday Tech Talk. And today we're going to review the market, where we are right now, look at the market posture. And if this is your first time here, what we generally do is talk for about 20-25 minutes, and we open the floor up for questions about whatever we're talking about, or individual stocks, or anything you want to talk about, targets or different sectors, that type of thing. We're going to jump right into it today because we have something a little bit different to talk about. And those that have been with us for a while are familiar with the CTI, but those that may be new subscribers, we're going to go into something that we call our market posture. If you're not familiar with that, it's in the weekly market letter. It's based on our proprietary indicators for the market. It calls bullish periods and bearish periods in the market. Since about 1974, it's been in place. It's outperformed the Dow almost 2 to 1. We've had a couple of good years with it. This year, we're underperforming the market, and that's because we'll get into it. But we kind of looked at I expected some weakness in the market sometime at the end of January and February. That we had to slip to a neutral position before going long again in March. But let's take a look at what's going on right now, and we'll get into the CTI and all next week. All right. First of all, we're going to look at the Dow Jones. It was up for a fifth straight week, although just barely last week. Momentum index rose a point to a neutral +3. Sentiment index remains neutral at 0. Breadth was also positive, but again, just barely positive. We started to see. You're talking about the AD line was up a couple hundred points tops, so not good. But the big event last week was that the CTI slipped to a -2, which is a bearish position on the market. However, with our CTI market timing model, we don't just rely on one indicator. Of course, we combine that with our momentum index and our sentiment index. So the CTI went to a -2, but we had a pickup in the momentum index. That meant that I changed the market posture to a neutral. The Dow closed on Friday at 21,394.76. We'll talk about how many points we made on the last call and stuff. But what I want to look at right now is, let me get my little arrow here, is talk about some changes in the market of what we're starting to see. Here we can see we've been bouncing off this upward trending line, which is kind of right coinciding close to the 100, a little bit below the 50-day. But we had this breakout over here on the Dow, broke this resistance area, and then proceeded to do almost nothing after last Monday when we made a new high. We just kind of stair-stepping lower. Today we're up about 9 points, but as you can see, the last 2 days in the final product, it's gone nowhere, and the market is totally mixed. Now we're starting to see some negative divergence in the histogram here. As we made a new high, the histogram was lower, and then about the middle of last week, we had a signal of a bearish trend on the MACD, the short term, the 1226.9. So that's something that we want to look at. The AD line also it made a new high yesterday. However, that's a positive going forward. But it's not like, we're not seeing a big pickup in advanced decline issues. And actually last week, one day, we had more new lows and new 52-week lows and new highs. So again, that's something that we want to keep our eye on because the negative divergence is popping up in several indexes. Here's the S&P 500. Again, we get this little breakout over here, and then nothing. We got a new high over there, and then we're just going sideways. Some people call that a coil, which could break, one way or the other. Usually on a breakout, it'll go higher. But, again, the negative divergence is a concern. Here we have the histogram again. As you're breaking to a new high, you're actually going negative with your momentum trend here. and that actually went bearish right over in here at this point. We're still bearish. My 30-day stochastic is close to coming down below this 80. We'll see what happens on that. So again, negative divergence on the S&P 500. A break below 2405 to 2410, that area, and we're at 2439 right now, could induce some more selling. That would be a break of that 50-day, which we did briefly for 1 day back here in mid-May. That was that day we dropped 300 point on Trump. Trump did something, I can't remember. But if we get a little bit of pullback to that 50-day, we start to break it. That could induce a little bit more selling. With this negative divergence, we want to be aware that could be something we're in line for. Here's the NASDAQ, which doesn't look as good. This is been the leader all the way since the election. Now we have a lower high. If we would come down here and take out this 50 and trade below 6,100, that would signal a lower low also, which a lot of traders would notice. That would get you below the pivot point, and people would start to look at the short rally. So we want to keep an eye on that. Again, the histogram negative divergence did not confirm this high over here. You see over here we just barely, the momentum trend just barely made that. And right after that, within 2 days, the MACD gave a sell on that. Here's the 14-day RSI. Again, showing slower momentum, almost going negative over here now. And again, when you made a second new high over here, it was not confirmed by this. So again, we're seeing negative divergence in the NASDAQ. And we'll look at the different sectors and go, show you some more things on that as negative. All right, if you've been reading the daily letter, especially, and also the weekly letter, you know that I've been talking a lot about the Russell 2000 and Dow Jones Transports. But I think that is something you can keep an extra eye on just to see if we're going to be able to push higher or lower. Here's the Russell 2000, which is a small cap index. This is the small caps. Should be the main beneficiary of the Trump trade, and here's all that. This is basically going sideways since early December? Yeah, so just the end, about mid-November actually. We had that big initial spurt, and then we're just kind of going sideways, and even the indicators are just barely getting along. Now we had a new high here about 2 weeks ago. Again, was not confirmed by the MACD. You kind of have a double top on the 14-day RSI, but not negative momentum yet, but it's slowing down. Even a 30-day, you have a lower top on that. So that's a little bit of a concern. If we come down here fall below about 1395, would be trouble. We're sitting right here at 1419. So we're just kind of right here where we are towards that new high. Kind of tough calling a top when you're this close to a new high, but when you're at a new high and you start to see these negative divergences, that's the red flag that says, okay, now I want to start looking. It doesn't go up forever, and now I want to start thinking about what am I going to do if some of these support levels are broken, and that's what you want to see up here. You want to see negative divergence when the market's getting ready to roll over. You don't want to just have this thing go from here to boom, just collapse like that. You want to have a little bit of warning, and this is giving us a little bit of a red flag now. Here's the Dow Jones Transportation Index. Couldn't get anything going. We finally broke out here a couple of weeks, and again, we ran up here. Couldn't get to the new high. Ran the resistance up here around 94 something. Kind of going back and forth. The 100-day moving average and 50-day are right over here, but we're still having a little bit of slowing momentum. The MACD is kind of neutral. I want to see this thing, for the rest of the market to really get going, this needs to pop up here and actually go up here and challenge this new high. I'm not sure it has enough strength to do that, but keep your eye on it. We're up, it's up a quarter of a point today, or quarter of a percent, so nothing big. But again, this isn't a chart of power or anything like that. So it's not really a red flag, but just something to be concerned with. All right. Now, what does that mean to you all when you're having these things up here with this negative divergence? This means that I want to be cautious on the market here. I don't think that you need to be chasing anything. Whatever you're long, you can hold on to at this stage. And we want to just wait until the CPI leads us into whether it's going to go negative, and that would be because the overall market begins to show less momentum or underperforms the Dow. Then we would start thinking about maybe selling some positions. But right now, I still think we're in a neutral position, and we could get a day or two here where we kind of get a little bit of a move up, but I still wouldn't be chasing or buying a lot of anything really new in here. Now, I wanted to talk about the sectors briefly before we go on to the CTI. And out of the 11 sectors that we have, currently we only have 2 that I consider in a bullish trend. We have 6 that are neutral, and then we have 3 that are actually negative, although one of them is starting to turn over here. Now, this is the healthcare sector. We've been talking about this and the biotechs for quite a while. We've had a nice trade in there between the hospitals and the biotechs. I hope the IBB, when we talked the last couple of weeks, is that when this thing breaks 300, you want to own some biotech. So we're nibbling away. We got that break. We went up to about 325 or something on the IBB. You get yesterday and today, you're having a little bit of a pullback. When you have a move like this, the IBB looks just like this. You have a little bit of consolidation. That's perfectly natural. I don't see any the negative divergence in this thing yet. I think that the healthcare can kind of hold the market, the broader market up a little bit. It's a heavily weighted sector, and it's in a bullish phase right now, and I think we can maybe move a little bit higher. Now, another one that's kind of strange. This is the real estate, the REITs sector. It's also in a bullish trend, moving higher, and I don't see any negative divergence in this. Part of this is because the 10-year Treasury just cannot seem to get going. It's up today. I think we bought them yesterday at about 213. Today we're up almost to 220. So a good move in that. I think a lot of that's because of the. I'm not really sure why it's up today. I'm not quite sure, because we had some. The IMF, the International Monetary Fund, actually cut the U.S. growth, economic growth from 2.3 to 2.1, and from 2.5 in 2018 to 2.1. But anyway, the 10-year yield was over. It was down at 2.13, 2.14. It was oversold. It was due for a bounce. We'll see if this thing can hold. But that's helping the financial sector big time today. And what I think you want to see is I'm not sure what I did here with John Connor here, but John, don't join us in yet. You can ask questions later. But anyway, the REITs, because of that low yield, have had a pretty good move in here. So the REITs, I do like them. However, I think you have to be careful which ones you buy. Do your homework, and don't buy something that has like an 8 or 9% yield. You're probably better off with these REITs that are looking at there's some growth. They're buying good properties, and they're maybe paying 4.5%, 5%. Okay, as far as the neutral area goes, here's the telecoms, which haven't really done much over here. So we get a little bit of a yield play out of AT&T. Verizon doesn't look good to me at all, but a few of these look okay. But this is just a neutral chart. Momentum has slowed. I don't see much upside on that right at this point. Here's a consumer discretionary select. You had all this retail problems, especially with the brick and mortar stocks. But we do have the negative divergence in those. Here's the histogram going lower. And ACD already has the sell signal in here. The 30-day stochastic, when it falls below 50, it usually means we're going lower. So this is something that be selective on that. Your Home Depots, your Alta, a few of those that I like still, but be selective on those, and you want to buy the ones that are what's the word? Just only sell like the one product, that type of thing. You don't want to be the broader stores. Here's the materials. I also consider this at this stage neutral. You have a sell on the MACD, slowing momentum. You're coming down here. You're working your way lower. This thing breaks below this level right in here from the lows from about a week ago. You'll be in another process of making lower highs and lower lows. Keep an eye on that. Another neutral one in here is the consumer staples, which is moving lower. The sell on the MACD, but you see the slowing momentum. Not sure why this thing is down as much as it is, because with the low yields, the consumer staples usually will outperform a little bit. But they're not in this case, which is a little bit troubling. Okay, another neutral sector is the technology is neutral in here. Again, you have negative divergence. MACD gave a sell back on that big day, and it's still on a sell. When you have something like this, like a runaway freight train, like the technology sector is, it's a little bit of a problem to me. You have to consolidate some of those gains. Whether that's what we're doing right now, we'll see. The semiconductors down again today. It's down almost 0.87%. The Philadelphia Semiconductor, it's got support around 1,000. The SOX is trading right now at about 1,068. So I think you probably have a little bit more downside. We'll see what happens down here on the 50-day. But again, the negative divergence, the slowing momentum is a concern for the market going forward. Now, as far as the negative goes, here we are with the energy, which continues just to go lower. I didn't draw this very well, but you are once again down here at the bottom at the end of this channel, so you could get a little bit of a bounce in here. We've talked about that before, but I think it was over in here or over here, one of these places. We said, don't buy. I think it was right here. Don't buy this thing here. We're just going to the top of the channel. You want to get out of your things there and wait to buy back at the bottom channel. That's what we're kind of doing like this. I don't know how far this will go up, but again, that's still a problem for the broader market. We're at 44.25 right now. Upside's probably 45, maybe 46. If this thing can get up to here, you might see crude oil at 48. But this is one of the busy seasons right now, and I would think that maybe towards the end of the summer you could see a retest of the $40 level on crude oil. So that's just a trade to me. When you have a distinct channel like this, and you buy it here, sell it up here. And the other negative one the other one was financials. Financials actually look are neutral. They're having a good day today, but they just can't seem to get going. And if the 10-year Treasury yield falls back here around 215, that again will bring in some selling. It's up about 1.20% today. If they can't, that and the healthcare sector, they're the most heavily weighted sectors we have out there. So if those two can, hold it up in here, perhaps we can, maybe just trade sideways and stay in neutral position. All right, we're going to talk a little bit about the CTI now because we have a pretty good track record with that. We did slip down to a -2 on the CTI. If you're not familiar with it, the CTI itself is one of the components of the market posture. And what we do with that is the market we have it broken down into 5 different cycles of different lengths. The cycles seem to run through nature. They seem to run through a lot of business cycles and all that. They have pretty distinct periods that we use. And when they're in harmonics, when they trade in harmonics, it means that certain of them will peak at the same time, and then a majority of them will bottom at the same time. We use 5 cycles that we look at right now: A, B, C, D, and E. Cycle A is 6 weeks, B 18, C is 36 weeks, D is 72, and E is 216 weeks. It basically runs about a 4-year business cycle. It's kind of built off of the business cycle, which generally has run about 4 years. Now, we didn't use the CTI for a couple of years back in 2008, 9, 10, maybe 11. And that's because every time the business cycle would begin to slow, you had the central banks running in and propping up whatever was slowing, and they basically, what happened is they eliminated a business cycle, so it didn't work very well. But now I think what's happened is the market has adjusted to these low rates, and the business cycle is coming back in. We've had a pretty good trades off of this for the last couple of years. Currently, like I said, the count is -2. The counts for A, B, and C are all negative. That the 6 weeks, 13, and 34 is where we are. That will, those change weekly. A is probably going to flip over within the next week or two. The current count at this Friday will be 2, and then we go into a -4 down to about a -8. And the negative counts stay with the market into August. So it's my feeling that we're probably about had the top on this little bit of a cycle at this stage, and we'll see what happens in end of August, September. Now, when a count is a negative number, we rather than just trade the market off of that, we mix that with the momentum index, which is another proprietary index, a proprietary indicator. And what we do with the momentum indicator is it's going to measure how other indexes and how the internal breadth of the broader market is doing compared to the Dow Jones. If the other indexes are outperforming the Dow, it's going to give positive numbers. If the Dow is outperforming all the other indexes, meaning the general is marching alone, then it's going to be a negative count. Now, as of the close, or as of midday today, we've gone from a positive 3 last week down to about a -4. So I'm leaning that we probably will go to a sell on the broader market this Friday, but we'll have to see. You need to read the weekly market letter on Friday to see what happens. Now, we also throw in a sentiment indicator where if we have too much bullishness, that would go towards a negative leaning. Right now, we're neutral on it on the sentiment index, but again, whether people are too bullish or too bearish, that influences the market posture. Okay. Now, what we have done over here, here's the Dow Jones. Now, this year so far, if you were going long and short the diamond, based on our market call, the Dow's up about I think it's 8.1%, something like that, and we are down about 1.5%. So we haven't done well. And the reason is this: this is where the election came in last November. We were we were negative on here because we thought somewhere in this period the market would probably come down here and take this out, and we would make a new low somewhere in January or February. So we were bearish on the market. We missed that. We were on the wrong side of that. We went neutral right here in February, right at that point, and then we went to then we went bullish again right over here, and we've done okay. We've made it back a lot of what we had lost, especially on the leveraged things. And we're going to go into the leveraged ETFs here real briefly. But so looking back here, once we broke out, and these cycles are not just you don't just set them in there and let them go. This meant that when we broke out here, this meant that this low here ended up being the end of our 4-year business cycle, where all the numbers were in count. I believe at that time the counts were 6, 18, 18. That one was short, but the cycle D was at 62 and cycle E was at 207, which are within the parameters of our cycle. So that meant that we adjusted this back to here, which means we would have gone long here, gone short somewhere over here, and then now we're getting ready to go short again. But that screwed us up. And these things you're always adjusting the cycles to the backside, so you'll catch the next inflection with the market, whether it's up or down. And in this case, again, we were wrong, and we went to net neutral. This was a hell of a move in here. You don't see that, but you do see the movements like this at the beginning of cycles, and that was another reason why we thought, if this was the end of that, this is the start of a new bull cycle. This would be a move like this would be fairly common. So that was where we adjusted it back to 1 for the 4-year cycle. And we're going forward. We think we're longer term. We're in another bull market, but we're due for a period of weakness in here. And at this stage, I don't see a 10-15% pullback in the market. But even if we get back down here to the 100-day or so, that would be about a 5% pullback in the market, and that's very realistic. So last year, like I said, we stayed bearish in the market, neutral from February to March. That was a bad call. Then we went long, and we just went to a neutral. If you did the triple leveraged ETFs, and we have a couple questions coming in already on that, and we're going to talk about those in a minute. Up until November, you had made about 70% on your investments, and then with this thing popping up here, and then ended up for the year, we ended up being up 55.49%. This year, we are down, I want to say about 4%. If you were short here, and then you went long here in March again with the triple leverage. You know, you had made back some money, but you're still down for the year. You're basically flat. Now, someone's already asking about the quadruple leveraged, you know, buys and short. I'm not going to go with that because if you're new here, these are triple leveraged ETFs that we trade off the CTI with. For the short side, we use all four different indexes. The reason being because you can have the Dow go up or down 5%. You might have the Russell go down 15% at that same time. Just like year to date, the Dow is up 9%. I think the QQQs were up like 14, 15%. So when you do the leveraged ETFs, you get quite a trade on that. Okay. Here's what we did so far this year with 2017. Okay, with the short Dow, we lost going into February. We lost 10.7%. We lost 13.9% on the S&P. We lost 20% on the QQQ, and we lost 8% on the Russell. Now, what we usually do is say if you have 20,000, you put 5,000 in each one of these things. Okay, we went long the UDOW, the SPXL, TQQQ, and URTY. We made some of it back here, 7, 7, 22, and 4. And the total for year to date, if you closed them all out on Friday, you're down 3.28%. Not what we want, but we did, you know, compared to what we've done before, it was okay. And I can't believe here. Okay, for some reason I had the trades for last year, 2006 and 2007. I think I might be looking at the wrong cheat sheet here. But I had all the trades. I was going to show you where we went long and short all of these. But okay, in 2015, the Dow was down 2.2%. Just going long and short on the diamonds, not doing the leverage stuff, we were up 18.2%. In 2016, the Dow was up 13.4% and made 2,337 points. The market edge long-short approach, you made 4,545 points, and you were up 26.1%. So we've outperformed the Dow handily the last 2 years. This year, if we do get some pullback, we'll make it up fairly quickly on this year. Like I said, the Dow's up 8.3%. The market edge long-short approach, we're down 1.9%. So, you know, you're going to be right or wrong, but hopefully if the market does pull back a little bit, we'll catch up on that. So, again, we're going to probably go to a short position on this Friday. I would say if you're watching the market, I don't recommend front running the calls, but if we work our way lower here the rest of the week, I can pretty much guarantee you that we're going to go to a short, and you can look at some of these the SDOW, SPXS as a way to play that and leverage your other positions to the downside. I'm going to open it up now to these to questions. This is a lot to cover if you're new subscriber on this, and I suggest that maybe you look over the CTI portion of this. You can go on the home page of Market Edge, and you can down to the Education Institute, the lower right-hand corner. You can read a little bit more about the CTI, and it goes into the harmonics of the different cycles, that type of thing. And then after watching this again and reading on it, if you have some more questions, please feel free to give me a email. You can do the doc at marketedge.com or support@marketedge.com, and I'll try to get a little bit more in depth. Okay, I'm going to open up to some questions real quick here. Linda, can you tell us which weeks we are in on the cycles? Yeah, I just did that. Right now we are at, my notes are all over the place right now. I think 6. Hold on here, Linda. Here we are. This is where we are as of last Friday. So this will be, if we make a new low, this would be, this would go to 1. If we make a higher low, this would go to 7. Then this would be 14, 35, 35, and 35. But these all three will be negative going, beginning this week. Can you comment on seasonality patterns? Is it summertime, often slow, especially August? Yeah. How that plays into the CTI is not really that relevant. However, it will, as far as maybe some sentiment goes. And I do, the summertime is probably one of the worst seasons for the market going forward. The summertime slows. So again, we're probably going to go negative, but understand that if the market keeps working its way higher, sideways to higher, and the momentum stays positive, we could stay neutral in the market into July and maybe even into August and never go to a negative. That's why you don't want to run front run this thing. So it's not just like, okay, we go to sell in the market because the CTI is negative. You have to take into the other proprietary indicators too, just to make sure. But as of right now, I say, well, we're not buying anything new. We're going sideways. We're holding on to the positions. Maybe we can start to scale off if this thing starts to collapse at that. Okay, for new long positions in XLV and REITs. Yeah, we've been talking about especially in the healthcare for the last couple of weeks. We said be looking at these biotechs and you want to buy them, and if it breaks above 300, you're going to get a great trade in that IBB, which we've gotten. I don't see any pullback in there yet. Biotechs right now are off about 0.5%. Pharmaceuticals have a little bit of a pullback, but that's just normal, healthy consolidation after a move like we've had. Technology, we'll have to see. The semis are down 0.8% today. We're staying above the 50-day. We'll see if that can bounce back and the SOX heads up towards new highs. That could keep the momentum index positive again and keep us at a neutral going out another couple of weeks. We'll have to see on that. As far as long positions, you have the hospitals seem to be doing well. We've talked the last couple of weeks about buying medical supplies, medical devices. I think if you've been here the last couple of weeks and bought a couple of those suggestions, I think you've done pretty well on those trades. The REITs, again, you're very selective. If you're an older guy like me, if you're looking for some incomes from dividends, yes, the REITs seem to be working very well. We're in a low environment for interest rates for a while. I think some people sold off some of the REITs and maybe the consumer staples too, and utilities thinking that, well, okay, we're raising rates again. When are they going to stop? I think they've stopped at least for the rest of this year, and the reason being, with this 10-year Treasury yield stays down here at 2.15, 2.14, 2.16, they can't raise rates anymore, and the reason for that, the yield curve is already very flat, and you're not going to raise the short-term yield up to the point where you're going to get an inverted interest rate curve. If you do that, the Fed's going to throw us into a recession, and that's not what they're going to do. They don't want to do that, so I think that will keep a floor possibly under the whole market if we keep around this 215. That's keeping me saying that okay, maybe you get a 4 or 5% pullback on this cycle, maybe a little bit more if we have some bad news come out, but I don't see a 15% market drop, mainly because interest rates are too yield. Okay, another question coming in about oil. What's your outlook? We talked about that. If you go back to this oil, wait a minute. Okay, here we are with this energy. Oil's following, or energy follows the oil cycle down here. When you get into this lower channel, you're going to get a bounce. This is what we have here. We've had oil up, I think, 2 or 3 days in a row. You get a pretty good bounce today, but I think if you can if you go long some of the oil plays and you see crude oil get up here around 46 or 47, I think you go ahead and say thanks for that little trade, and then you wait to see this thing come down. I think you'll see oil in the late summer come down here and test 40, especially if we go below 43 again, because like I said, so far when it gets up to this top channel, you go short, then go long at the bottom channel. You've done pretty well. We've called a couple of these things on these tech talks. Right now, I think you can probably get a little bit more of a bounce in that. Okay, we've gone. Our time limit's pretty much up. I don't see any more questions coming in. If you do have some more, please just send me an email. For those that have taken time out of your busy day to join us, and I hope you got something out of this today. I really appreciate you taking your time to join me on this, and read the market letter on Friday because it will give you some more hints, or at least tell you what we're going to do with the market posture, whether we're going to go to a sell or whether we'll stay neutral. All right? Have a good week trading, and we'll talk to you next Tuesday. Thanks again.